Back to Salesforce now. Wow, shares in the green, pretty much at their overtime highs, more than 7% higher on better than expected earnings and better than expected earnings guidance. Joining us now to talk about it, Rishi Jaluria from RBC Capital Markets. Rishi, this is, it's mainly about the bottom line, right? The revenues to me look about in line, as does the revenue guide, but there's a lot of successful belt tightening at Salesforce.
Yeah, and thanks so much for having me. I think that's exactly right. It was a pretty inline quarter, pretty narrow beat on the revenue side. And if you look at the guide, pretty much in line. They are actually guiding to, close to single digit CRPO constant currency, which is the best leading indicator we have. But we're seeing a lot of margin expansion. We're seeing cash flow grow faster than expected. And I think it is this new discipline that Salesforce is bringing and investing a little bit more cautiously, being smarter about where they're putting their money. And I think there's, by the way, a lot more room to go in the margin expansion story. Right now, they're a little bit above 30% margins. I think this thing could get to 40% margins over time with the right amount of discipline and cost control.
Yeah, but Rishi, it takes a special kind of market to continue to get excited just about margin expansion and not about top line growth. So is this operational discipline buying Mark the kind of credibility that he's going to need to get back in the M&A game if that's what it takes to grow the top line?
Look, I think the balancing act that Salesforce really has to do right now is show this margin expansion without dramatically compromising growth. Yes, growth is decelerating, but that makes sense given the macro environment that we're in. The fact is they're still showing double-digit growth when everyone is worried that they may not be able to do that. So I think as long as they can demonstrate even 9-10% growth, but show that dramatic margin expansion, which won't be easy, I think that's enough. In terms of your question on M&A, look, when I'm having conversations with investors, that's the last thing people want to see. Yes, some of the acquisitions are starting to do better. MuleSoft, especially, I would call out accelerated against a tougher compare. However, there's a lot of work to be done in integrating these assets. Marketing and Commerce Cloud are still not fully integrated, and they bought ExactTarget, 10 years ago. So I think investors, and I would agree with this, would rather see the work put in integrating all of these acquisitions rather than going out and buying something new outside of small technological tuck-ins or acqui-hires.
Yeah, we talk about cost cutting with Salesforce. When you talk about the focus on margins, how does AI fit into that picture from an investment standpoint, an integration and deployment standpoint? What does that mean, not only in the near term, but in the long term in terms of Salesforce's ability to compete in that landscape and how investors should be thinking about that with such a focus on earnings right now?
Yeah, absolutely. Look, I think to level set, we're incredibly bullish on generative AI's technology. I would say AI is a little bit of a mixed bag for Salesforce right now. On one hand, they have the data and distribution and use cases that they should be a major beneficiary from generative AI. On the other hand, we haven't seen quite the killer apps that we want to see out of Salesforce, right? We haven't seen the equivalent of GitHub Copilot or Microsoft 365 Copilot that would be followed by monetization. So I think that Salesforce has an opportunity to show us more. But so far, after their AI day, after Dreamforce, we just haven't seen enough to get super excited about an AI story for Salesforce yet.
Okay. It's the top performer in the Dow this year. It's up more than 70%, and it's up another 7% right now in after hours. Do you still buy the stock here?
Yeah, look, I think there's still, like I said, there's still room for margin expansion from here, right? If we think about best-in-class software companies, they should be at 40% margins. You can't fire your way to that. You have to overhaul the go-to-market. You have to integrate the products, make a lot of changes. But if this company can get to 40% operating margins and still show even high single-digit growth, I think the stock is probably undervalued at current levels. So as long as you believe they can execute and still continue to grow, the stock, I think, is worth holding on to.